Are you thinking of selling a rental property? You might need to be aware of capital gains. We're going to talk about this, how it works, what does it mean, and when is it triggered right after this. Hey everybody, my name is Jared Chamberlain and I am here today with my accountant, and we're talking about capital gains. How does it work? What does it mean? But if you're finding our content valuable, we really encourage you to subscribe to the channel, hit that like button, and share the videos. And for sure, comment below. Put your questions, even where you're watching from, anything like that, because that all helps us with our reach in helping families move up here in Calgary. But today, I am joined by the one, the only, Mr. Robert Neufeld.
Thanks for having me.
You've come here a couple times.
Yeah, I think second time, maybe third time.
Maybe third time.
Yeah.
I mean, I've seen you way more than that.
Well, as you should.
As I should. How long have you been our accountant?
Probably 6 years, maybe.
I was gonna say six or
something like that. Yeah. It's been a while.
Well, we're still around. You do a fantastic job.
I haven't screwed up too badly.
not that I'm aware of, anyways.
I wouldn't let you know.
Oh, good. We're gonna end the video here. No, just kidding. So there are a lot of people that are, and it's funny. I was talking to one of our mortgage brokers that works in the office here today, and he was saying he's talked to a lot of people too who are considering selling rental properties. Mm-hmm. And you probably have had more calls about it. Like, how does this work? What do we do? Or when you're starting to do year ends or whatever.
Yeah.
It's something that's real, right? And people are selling rental properties because the values are higher. Mm-hmm. And so one of the questions we get all the time is, well, how does capital gains work? How does this play out when we're actually selling a rental property?
Yeah.
And so we wanted to talk about that today and get your input, your insight. And so I guess maybe let's just start simply, but what are capital gains? Okay. How does that look, and what is the basic idea of it?
Yeah. Okay. So the basics are, capital gain occurs when you sell property. The same concept applies to a lot of different items that you would invest in, rental properties being the one that we're talking about, but also to stocks and investment portfolios, things like that, different types of investments. But for a rental property, I think the easiest way is probably just to run through a quick example. So
sure.
If you were to buy a rental property for $400,000, own it for a number of years, and then 10 years down the road, you sell it for $500,000.
Yeah.
So in that case, you've got a gain of $100,000.
Yeah.
And that gain is considered a capital gain. Now, there is a capital gain and there is a taxable capital gain.
Okay.
So taxable capital gain is 50% of the total gain. So of that $100,000, 50% of it is taxable, 50% of it is not taxable.
Okay.
So you get to take $50,000, put that in your bank account, and
tax-free.
Tax-free.
Right. Okay.
The other 50% is taxable. And so that $50,000 in our example, that gets added to your, if you own the property personally, that gets added to your personal tax return on Schedule 3.
Yeah.
And you will pay tax on that $50,000 at whatever tax bracket that you're in. So for example, if you're in the 30% tax bracket, you'll pay 30% of $50,000, and that'll be the tax on that gain.
Okay. So it is fairly straightforward.
Yeah, in a simple scenario.
Simple scenario. I think that's the key, right? Because so many people, no one has a simple scenario when they're selling, and that's the reality.
Yeah.
And so, but again, 50%. So is what I'm recapping what you said. 50% of the gain is taxed at the rate of what your personal taxes are at.
That's correct. That's exactly right. You got it.
Nailed it. Now we can end the video.
Yeah.
Okay, so that's how capital gains are taxed on the sale of a property.
Yeah.
So how can you avoid paying capital gains? Because we've actually had people say, well, how do I get around this? And you're like,
you don't have a rental property. Don't sell it without a gain.
Don't sell it then.
Yeah, don't sell it.
But again, someone's like, well, I'm going to bring this scenario up later, but can you avoid paying capital gains on the sale of a rental property?
Not really. They will be added to your income. Now, there are some things that you can do to reduce the physical cash that you pay in taxes. For example, if you had 2 rental properties,
right,
and one was doing really well, you were able to sell it at $100,000 gain, and one was not so well, and you sold it at $100,000 loss, the capital gain and the capital loss could very well cancel each other out.
That's right.
And so if you same if you had a stock portfolio and you had some stocks or investments in there that were not performing very well, and you wanted to get rid of them, maybe getting rid of them in the same year that you sell your property as a gain, the capital losses and capital gains can offset each other to reduce your tax bill.
Okay. Well, I mean, it's good to know, because if for you who is watching this, you obviously are in a situation where you are considering selling that rental property, and if you have other investments that can be sold, that can sometimes offset, on the other side too. So if you have, let's say, some stocks that you're planning on cashing in and there's a gain, and your rental property is at a loss, but it's higher than what it used to be worth, and it's kind of makes sense, you could also offset it that way. Is that correct?
Right. That's right. Yeah. So capital gains and losses, depending on, whatever the source is, by and large, you can offset them.
Yeah. Okay. So one question that I've had that I've always kind of think is interesting, because you hear things on the interwebs or from friends being like, hey, if you reinvest the proceeds really quick from your capital gain, you don't have to pay it, right? Is that true?
No, I'm sorry. No.
Has there ever been anything like that that you recall?
Not since I've been practicing. There are things, and maybe there's a very complicated and, for somebody in a very, 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 very high tax bracket who can hire a very fancy lawyer to do something, but by and large, no. If you're selling a rental property, you're going to pay your capital gains tax on it, and then your residual proceeds you can go and invest and do whatever you want. But the other thing that you could do, speaking of offsetting and what could you do to reduce, is those capital losses. So say you had a loss from some stocks last year,
right?
But you didn't have a capital gain last year to offset them. So those capital losses, they're sitting in a notional account that you can carry forward to this year when you sell your property at a gain.
Oh, interesting.
And so same thing works with a property. If you were to sell it at a loss this year, and then you have another one you sell at a gain next year, you can carry that loss forward to next year. And you can carry those losses forward indefinitely. They just sit on the books to be used in the future.
So do you have to kind of be proactive and know that could be happening in the future, or are they just there?
They just sit there. When you have a capital loss, it is tracked by CRA and by your tax preparer. If you're using the same software year after year, it will generally carry it forward, and CRA also tracks those.
Okay. Yeah. So that's a great tip.
Yeah. If you've got losses in the past, it's something to keep in mind when you're selling now.
Yeah. Okay. So no, that's good. So I guess the other question too is, are capital gains taxed? Is it come in play when you sell your personal home?
No. So when you sell, if that same scenario were to occur, if you bought at 400, sold at 500,000, but it was your only real estate, you lived in it the entire time, it was your principal residence, you still have a gain, and you do have to report that on your tax return. But it is exempt from tax, and so you fall under the principal residence exemption. Okay. Yeah.
So, but if at any time it turns into a rental, so there's a lot of people, and you might be in this situation, right? Where let's use real days here for Calgary anyway. So like 2014, you buy a property and you live in that home, and it kind of was the high time of the year, or like a seasonality, cycle, and you paid a lot. Values dropped, and you now are like, well, I need to move again. And it's 2018, and
And it's worth much less.
It's worth less. You know, if it went down 40 grand, let's say.
Yep.
And you're like, I just can't take that loss. We can pull equity. We can keep it as a rental. Now, 2018 to today, it's been a rental. So the capital gains, so let's say if it goes back to that value that it was in 2014, or maybe you're actually able to sell it for 20 grand more. So now that $20,000 increase from what you paid back in 2014, is it taxed from the 2014 date, or is it taxed from the 2018 date?
It depends.
Oh, man.
And yeah, there's no easier answer to that one. In a scenario like that, when you have a change in use, so in 2018, you would have had a change of use in that property. It went from principal residence to a rental property. And you can also have the opposite, a rental property. You move into it, can become your principal residence. And so in those scenarios, there are elections that you need to file or can file at the time of change in use. Taking note of what the fair market value is at that time is an important thing to do. But the tax on it will depend on your other scenarios. And so there's too many functions or too many variables in a scenario like that to give an easy answer. The easy answer there is talk to your accountant.
Totally.
Because because the change in use rules do apply, because capital gains may apply, principal residence exemption may apply for portion of the ownership of it. It can get quite complicated, so it's something to certainly talk to your accountant if you're in that scenario.
Okay. Yeah. But is it safe to say that, I mean, capital gains isn't going to go for the whole time?
Likely no. Likely the time that you lived in it from 14 to 18.
Let's say it went from 2000. Let's just say you bought it at 400, using your example. Went up to 450 value. You turned into a rental. It went to 500 in value today. And so the first 50,000 that it went up before it was a rental, there could be some taxes in there depending on your situation, but most likely it was your personal residence. Yeah,
most likely you could do a disposal as your principal residence for that gain. And then the gain from the change in use to the final sale would be a capital gain. Yeah. Okay. But again, there's a
lot of factors.
If you owned a different property as well, like if you had a secondary property or a cottage property, and that was your principal residence, or deemed to be your principal residence, then the full gain could be taxed. So
interesting. Okay.
There's 1,000 scenarios and everyone is just a little bit different.
And we don't have all day.
How long do you want this video to be?
That's right. No, it's true. So I guess one thing we were talking about before is there's a few tips. We're not going to get into them. We're not going to go like this deep dive into talking about how these things work. But there's definitely some tips and tricks and situations that, again, talk to your accountant about. But one of the ones you brought up was called capital cost allowance. In your world, CCA, you said our world, it's better for us to call it a depreciation expense.
Yes.
So maybe just a quick little 30-second, what is that, and when is it happen, and when is it worth bringing it up to your accountant, right?
Yeah, so when you have a rental property, you have the option of taking this expense each year that you own the property. And what it does is it reduces your taxes on the rental income that you're earning throughout the ownership of that property. But what it's also doing is it's depreciating the value of that property for tax purposes. And so that example where we bought it at 400,000, if you're taking this depreciation expense, you may depreciate the value of that house for tax purposes down to 350,000 over the life of ownership. When you go to sell at 500, you've taken an expense of $50,000 over the life of ownership, which you now need to repay back. That becomes income to you. It's called recapture, because you take an expense to depreciate an asset that actually appreciated in value. And so essentially you have to repay all that taxes that you took as a write-off over the life of the asset. So you may want to take that expense when you expect a property to depreciate in value, you may want to take that expense when you'd prefer to pay the full tax bill when you sell.
That's right.
Because then you have the cash from the sale.
Yeah.
So there are different schools of thought on it, when it's a good idea, when it's not a good idea.
Totally.
But it certainly can make your tax bill a lot bigger when you sell if you take that expense.
Well, especially if it's going to go up in value, because if it's
Exactly.
going up in value,
Yeah.
then there's a gap to close.
Yeah.
Now, if you depreciated it over ownership and it actually depreciated, then there probably isn't that big of a gap to close.
No, if you depreciated it to $350,
Yeah.
and you sell it for $350, then you've taken the accurate amount of a write-off over the life of that asset.
Yeah.
But like I said, if you sell it for $500, you've got to pay back the write-off you already took for $50,000, and then that $100,000 capital gain,
Yeah.
$50,000 taxable capital gain.
So fun.
So it's
No easy
the
answers.
fun is endless. Yeah.
The fun is endless.
You heard it here first.
That's good. So the other one and we actually shot a video on this, and I'm going to make sure you have a link over here it'll be. But a link that will talk about the terminal loss when owning a condo or the building portion. So maybe just you can touch on it here. But if you want to know more information about that, talk to your accountant first, or click through to that link that was up there.
Yeah.
Because we talk about that much more in detail. So what is a terminal loss?
So terminal loss, so when you sell a property, you can have a terminal loss and or a capital loss. Terminal loss is associated with the depreciable portion of the property, which essentially means the building portion of the property.
Yeah.
The capital loss is generally attributed to the land portion of the sale.
Yeah.
So if you're buying at 400, selling at 300, and it's just an apartment style condo, you've got a terminal loss. If you've got a house that has a land and a building component, then you quite likely have a terminal loss and a capital loss.
Right. Because the house and the land portion.
Exactly. Yeah. So taking note of the value of when you buy a property, when you sell a property, what portion is attributed to land and building is helpful. And we like terminal losses because they can be used against other income. Capital losses can only be used to offset capital gains. So it's more restrictive.
Okay.
So it is a good idea to just take note of the land and the building portion of the purchase and of the sale.
And I remember from our conversation about that, like if you have a condo and let's say you owned a condo, first property, and you moved into a house, but the condo dropped in value, you didn't want to sell it. And now it's like, dang it. Like now I need to get rid of this. I don't want to be a landlord. The market's a little bit better. I'm still at a loss from what I paid, but I'm okay with that. This is a great situation as a terminal loss is to look that up and talk to an accountant, figure that out, because that's how you might be able to recapture some of the losses that you have there. So,
because you can use that terminal loss against your employment income.
That's right, because it's not a capital loss or gain situation.
Exactly. You're out of that capital gain loss scenario. You're into a terminal loss, which is a better scenario, and hopefully get yourself a nice tax refund.
That's right. Well, hopefully this has helped you out. And if you are looking at capital gains and selling a property, hopefully you got some answers here. And if you have questions or comments, throw them in the comments below because we're always watching it. And if you have questions for Rob, put them there as well, and I can get them over to you.
Amazing.
But either way, how can people get a hold of you if they have questions for you about stuff?
Best way is probably our website, is hamrose.com, HAMROSE.com.
Okay, sounds good. You don't want to give out your cell number?
No. Not on the World Wide Web.
No, that's all good. You just leave the realtors to do that, right?
Yeah.
That's right. We're crazy. So hopefully this has been helpful. And if you have other questions, again, reach out to Rob, go to the website, or basically just put them in the comments and we'll see them. But again, I'm going to put that link up here one more time for the terminal loss, because there's a lot of people in that situation who are potentially selling a condo at a loss. But if you have capital gains, that's fantastic. But either way, hopefully this helps, and we'll see you guys on the next video.